Hello and welcome back to the channel. If you rely on cash for your weekly shopping or daily expenses, please pay close attention to this urgent banking update. A major shift in UK banking regulations is changing exactly how we access our money. In an effort to clamp down on financial fraud, major high street banks are quietly rolling out strict new security measures, multi-factor authentication, and much tighter daily cash withdrawal limits, particularly for those over 60. The risk. If you are caught off guard by these new verification checks, or if you attempt to withdraw larger amounts the old way, you risk triggering automated fraud flags that could lock your account or result in steep non-compliance penalties of up to $1,000. Today, I will walk you through exactly what these changes mean for your local ATM visits, how to navigate the new daily limits safely, and the specific steps you must take to protect your hard-earned pension from unexpected fees. Knowledge is your best defense. By the end of this quick video, you will know exactly how to manage your cash flow seamlessly without risking your peace of mind. If you find this practical advice helpful, please like this video to help us share this crucial warning with more seniors across the UK. To truly understand why these sudden changes are sweeping across the United Kingdom, we have to look at the shifting landscape of how money moves in our modern society. For decades, the local high street bank was the cornerstone of every community, a place where the tellers knew your name, where a friendly face would hand over your weekly pension, and where financial security felt personal and tangible. Over the past few years, however, there has been a quiet but aggressive push toward a cashless economy, a transition driven by major financial institutions and regulatory bodies aiming to streamline operations and minimize the physical overhead of managing paper currency. While digital transactions offer a high degree of convenience for tech-savvy generations, they also introduce a massive vulnerability that organized criminal syndicates have become incredibly adept at exploiting. This brings us directly to the core of the new legislation that is currently hitting ATMs across England, Scotland, Wales, and Northern Ireland. The government and the financial conduct authorities have realized that the traditional methods of securing automated teller machines are no longer sufficient to stop the sophisticated tactics of modern fraudsters. In their rush to erect a digital fortress around your money, they have implemented a complex web of compliance rules that, unfortunately, place the burden of proof squarely on the consumer. This means that an ordinary, innocent citizen trying to access their own hard-earned savings can easily trigger a red flag, leading to catastrophic account freezes and severe financial penalties if the proper protocol is not followed. When we talk about a potential £1,000 penalty, it sounds almost unimaginable that a bank could legally enforce such a hefty fine against a pensioner simply for using a cash machine. To make sense of this, we have to examine the fine print of the updated financial crime and anti-money laundering regulations implemented this year. Under these updated directives, banks are now legally mandated to track and verify the source, purpose, and destination of significant cash movements, a policy designed to choke off the funding lines of illicit enterprises. The unintended consequence for seniors, however, lies in how the automated security algorithms interpret standard withdrawal patterns. If you happen to visit an ATM and attempt to withdraw an amount that deviates even slightly from your historical data, or if you make multiple withdrawals across different locations within a short time frame, the system automatically classifies the activity as high-risk suspicious behavior. In the past, such an event might have resulted in a simple courtesy call from your bank manager or a temporary hold that could be resolved with a quick phone conversation. Under the strict new legal framework, a flagged transaction initiates an automated compliance review process, and if the account holder cannot immediately verify their identity through the newly mandated multi-factor digital channels, the bank is empowered to assess substantial administrative fees and regulatory penalties to cover the cost of the forensic audit. This is where the terrifying figure comes into play, as these penalties accumulate rapidly across linked accounts, leaving many retirees vulnerable to devastating losses before they even realize they have broken a rule. The mechanism behind these new ATM restrictions relies heavily on artificial intelligence and predictive behavioral modeling, technologies that are notoriously rigid and unforgiving. When you insert your debit card into a cash machine today, the system is not just checking your personal identification number and your available balance. It is actively cross-referencing your physical location, the time of day, the specific machine being utilized, and your historical spending velocity. For many seniors who prefer to keep a reserve of physical cash at home for emergencies, utility bills, or to pay local tradespeople, withdrawing a lump sum at the beginning of the month is a perfectly logical and deeply ingrained habit. The new AI-driven security protocols, however, view large, infrequent cash withdrawals as a primary indicator of elder financial abuse, coercion, or account takeover by scammers. The algorithm makes an instantaneous assumption that because you are accessing a larger amount of cash than usual, you are either being targeted by a rogue trader at your doorstep, or you are falling victim to a sophisticated courier fraud scheme. To protect themselves from liability, the banks have programmed the machines to demand immediate secondary verification that goes far beyond a standard 4-digit PIN. This is precisely where the trap snaps shut for thousands of unsuspecting individuals who do not carry a modern smartphone or who live in areas with unreliable mobile network coverage. Imagine standing on a cold, windy high street, waiting for the machine to dispense your money, only for the screen to suddenly go blank before displaying a message requiring you to input a one-time passcode sent to a registered mobile application. For a significant portion of the senior population, this requirement introduces an immediate and stressful barrier. If you do not have the app installed, if your phone is at home, or if you simply struggle to navigate the tiny text on a smartphone screen within the strict 60-second time limit provided by the ATM, the transaction is abruptly aborted. What happens next is where the situation escalates from a minor inconvenience into a full-blown financial crisis. The system records the failed verification attempt as a suspected fraudulent breach, immediately placing a restrictive hold on the debit card and flagging the associated checking and savings accounts for an intensive security review. If you attempt to remedy the situation by moving to a different ATM down the street or by trying an alternative card from a different bank, the interconnected banking network views this as an attempt to bypass security controls, a behavior known in regulatory circles as structuring. This secondary flag triggers the automated enforcement mechanism, allowing the banking group to levy the compliance penalties we discussed earlier, justified under the guise of recovering the administrative costs of preventing a suspected major cybercrime event. The implementation of these harsh measures has been deliberately quiet, with many major high street brands bearing the notices deep within lengthy terms and conditions updates that arrive in the mail or via email newsletters that easily end up in the spam folder. This lack of transparent communication has created a massive information vacuum, leaving the most vulnerable members of our society completely exposed to sudden financial disruptions. Many people only discover the existence of these new laws when they find themselves standing at a checkout counter with a cart full of groceries, only for their card to be declined without explanation. The emotional toll of this experience cannot be understated, as it strips away a person's sense of independence and financial security in an instant. Furthermore, trying to resolve an automated account freeze is no longer as simple as walking into your local branch, primarily because hundreds of physical bank branches have been permanently closed across the UK over the past 24 months. If your local town no longer has a brick-and-mortar branch, you are forced to navigate convoluted automated telephone menus, waiting on hold for hours to speak with a centralized compliance department that operates under strict scripts and possesses very little flexibility to override an algorithmic decision. To navigate this treacherous new financial landscape safely, it is absolutely essential to understand the specific thresholds and behavioral patterns that trigger these automated security systems. The algorithms are particularly sensitive to what they classify as out-of-character transaction volumes. For instance, if your typical monthly ATM usage consists of withdrawing £50 to £100 for pocket money, and you suddenly attempt to withdraw £300 or £400 to pay for a domestic repair or a family birthday gift, the system will almost certainly flag the event. To prevent this, financial experts are now recommending that seniors intentionally adjust their withdrawal habits to match the rigid expectations of the artificial intelligence systems. Instead of making large, single withdrawals, it is far safer to break the amounts down into smaller, predictable increments spaced out over a longer duration, provided that you remain well within your established daily limits. However, even this strategy requires immense caution, because if the intervals between withdrawals are deemed too short, the system will flag it as an attempt to circumvent the daily cap, bringing you right back to the risk of an account freeze and potential regulatory fines. Another critical factor to consider is the physical location of the automated teller machine you choose to use. The new regulatory framework applies different risk ratings to ATMs based on their geographic location, historical fraud rates in the area, and whether the machine is located within a secure, well-lit bank foyer or attached to an independent convenience store or petrol station. Independent non-bank ATMs are now classified as high-risk environments due to the prevalence of physical skimming devices and digital interception hardware utilized by criminal networks. When you use an independent cash machine, the security algorithms apply a significantly lower threshold for triggering an account freeze, meaning that a transaction that would easily pass through a machine at a major bank branch might be instantly blocked at a local corner shop. Whenever possible, it is highly advisable to restrict your cash withdrawals to machines that are physically integrated into a functioning bank branch during operating hours, as these transactions are afforded a higher baseline trust rating by the automated compliance systems. Beyond the technical and behavioral adjustments, there is a profound systemic shift occurring behind the scenes that every pensioner must understand to protect their wealth over the long term. The broader strategy of the financial sector is to gradually disincentivize the use of physical cash entirely, as processing, transporting, and securing paper notes is a massive expense that reduces corporate profitability. By introducing highly restrictive security measures and severe penalties for non-compliance, the system subtly but effectively nudges consumers toward digital payment methods, such as debit cards, contactless mobile wallets, and online banking transfers. While these digital alternatives are highly promoted as safer and more efficient, they also grant financial institutions absolute visibility and control over every single penny you spend. For a generation that values privacy, autonomy, and the tangible security of physical currency, this shift represents a significant erosion of personal freedom, making it more important than ever to stay informed and adaptable, to ensure that you are never caught unprepared by a sudden ATM lockout or an unexpected compliance penalty. There are several concrete, proactive steps you can implement starting today. First and foremost, you must contact your bank directly to explicitly request a clear written statement detailing your current daily and weekly cash withdrawal limits, as well as the specific multi-factor authentication requirements tied to your account. Do not assume that the limits you have had for the past 10 years are still in place, as many institutions have quietly lowered these caps without requiring explicit customer consent. By knowing your exact legal limits, you can plan your financial affairs with precision and completely avoid triggering the automated velocity thresholds that lead to severe penalties. Secondly, if you do utilize a smartphone, take the time to set up your banking application properly, ensuring that all security alerts, push notifications, and location services are enabled. While this may feel like an invasion of privacy, allowing the bank's app to verify your physical location via GPS can actually prevent false fraud flags, as the system will see that your smartphone is in the exact same physical location as the ATM you are attempting to use. For those who choose not to use a smartphone or who find digital banking applications completely inaccessible, the path forward requires an even greater level of strategic planning. If you rely entirely on a traditional landline and paper statements, you should consider establishing a formal relationship with a dedicated customer care representative at your local branch, if one still exists, or through their specialized telephone banking service for seniors. Request that a permanent note be placed on your file indicating your preference for cash transactions and your lack of digital access. While this does not completely exempt you from the overarching automated laws, it provides a vital piece of documentary evidence that your legal counsel can utilize to contest and overturn any unfair administrative penalties or account freezes that the automated algorithms might mistakenly impose upon you. Additionally, it is highly wise to diversify your financial holdings across at least 2 completely independent banking groups. By maintaining a secondary checking account with a small balance and a separate debit card, you ensure that even if one institution mistakenly freezes your primary account due to a misunderstood ATM transaction, you will still have immediate access to emergency funds to cover your essential living expenses while the compliance dispute is being investigated. As we look toward the future, it is abundantly clear that the intersection of government legislation, banking automation, and financial security will continue to grow more complex and restrictive. The days of simple, frictionless access to physical cash are rapidly drawing to a close, replaced by a highly regulated digital ecosystem that requires constant vigilance and technological adaptation from its participants. This reality can feel incredibly daunting and unfair, particularly for a generation that has spent a lifetime working hard, paying taxes, and contributing to the economic fabric of the nation, only to feel increasingly alienated by the very institutions trusted to safeguard their wealth. However, true financial security does not come from ignoring these systemic changes or wishing for a return to the past. It comes from arming yourself with precise, actionable knowledge and refusing to be intimidated by the cold, algorithmic systems of modern banking. By understanding the rules of the game, anticipating the triggers of the security software, and adapting your daily habits accordingly, you can completely insulate yourself from the risk of sudden penalties and ensure that your retirement funds remain exactly where they belong, safe, accessible, and under your absolute control. In conclusion, the new laws governing UK automated teller machines represent a double-edged sword, offering enhanced protection against international fraud syndicates while simultaneously creating a minefield of compliance traps for ordinary pensioners who rely on physical cash. The threat of a £1,000 penalty is a stark reminder of how high the stakes have become in the digital age and how quickly an innocent misunderstanding can escalate into a severe financial crisis. You do not have to fall victim to these automated systems. By implementing the strategic adjustments we have discussed, such as avoiding high-risk independent ATMs, breaking large withdrawals into smaller, predictable increments, explicitly confirming your account limits with your bank, and maintaining a secondary financial safety net, you can confidently reclaim your financial independence and navigate the modern banking landscape with absolute peace of mind. Stay vigilant, stay informed, and always remember that when it comes to protecting your hard-earned pension, being proactive is the ultimate key to your security.